My view is that in a massively indebted world, to put this in perspective, the US is some 300 and something percent of GDP in debt, as total debts to GDP. It is 100% of world GDP in debt. It's the most indebted any nation has ever been. And everybody borrows dollars. And we're in a system where they're trying to act like Paul Volcker, because basically the Fed is run by a bunch of baby boomers and they want to get a book out where they're on the front cover like Paul Volcker to be the heroes. But I think what they're doing is fighting the ghosts of the past. The ghost of the past, the 1970s, was wildly different. We've talked about this in Daily Briefing before. The demographic setup is different. Also, the debt is different. I mean, the US is like 100% of GDP in debt, total debts at that point. We're now at least another 150%, maybe 200% of GDP in debt on top. So with an aging demographic and high debt, it's very difficult to generate inflation. But the Fed are now convinced they need to be Paul Volcker, and they are going to go and raise rates further than the market can deal with. And we're seeing it. We're seeing it everywhere, that the market's going, we cannot deal with rates like this and the liquidity that's happened. So liquidity has been drawn out by quantitative tightening. What they've done with the banks and what bank reserves have to be held has kept money out of the market. There's basically no buyer of the bond market. So there's a few charts, I think Claire's going to try and share them. Bond market liquidity is basically as bad as it was in the peak of the pandemic, when the bond market froze and everyone was worried Citadel had gone under, whoever had gone under. That's how bad the bond market is now. It is completely decoupling from anything, and I'll come on to that in a sec. The next chart, another way of looking at it, is bond market volatility. Bond market volatility is higher than stock market volatility. This is not normal. And again, we're approaching the peak of the absolute crisis when the entire world shut down and we thought everybody was going to die. Right? That's how bad the situation in the bond market is. What that's done is decoupled the bond market from the underlying inflation story. So this is not a fear of inflation, really, because the Fed are saying we're going to do anything to kill inflation. Well, what's happened is the break-evens rate has agreed with that and said, yes, inflation is not the enemy. And break-even inflation, I'm looking at the 5 years, is at 2.4%, which broke down today. And 1 year is at 1.95. So they're basically around 2%. So the market's saying forward-looking inflation is back to normal. Okay, but the problem is if bond yields are going up and inflation expectations are going down, you see this next chart, Claire, which is real rates. Real rates have been trending lower over time. This is 5-year real rates. So you need to have low real rates to stimulate the economy or run it normally. So you're raising real rates on people at a time when they can't afford to service their debts because there's too much debt out there.